All right, let's talk about Selective Insurance Group, or SIGI, because on July 24th, 2025, they dropped their second quarter earnings, and wow, the market's reaction was, to put it mildly, pretty brutal. So in this explainer, we're going to dig in. We're going to look at what went down, why it happened, and what this might all mean for them going forward. And this number right here, this pretty much tells the whole story. 17% down in one single day. I mean, that is a huge haircut for any stock. It tells you that investors weren't just a little disappointed, they were genuinely spooked by something they heard on that earnings call. And that really gets us to the heart of the matter here. You look at the top line and you think, hey, what's the problem? Revenue was actually up 11% from last year. So what gives? Why the massive sell-off? That's the puzzle we're here to piece together. Okay, so to really get why the stock fell off a cliff, we've got to peel back the onion a bit. We need to look past that nice revenue number and see what Wall Street was actually focused on. And here it is. It's a real tale of two cities. You see, revenue, that was fine. It came in right where everyone expected. But the real kicker was the bottom line, the non-GAAP earnings per share. The street was looking for $1.55. What they get? $1.31. A miss that big on earnings? That's a massive red flag. And it's what sent investors running for the exits. So the big question is, what went wrong? Where did that earnings miss come from? Well, if you ask management, they'll point to one thing, a kind of industry boogeyman that's been giving insurers nightmares for a while now. They call it social inflation. And this number, this is the smoking gun, $45 million. That's how much they had to set aside for what they call unfavorable prior year reserve development. Now, what does that mean in plain English? It means they went back and looked at old claims from previous years and realized, uh-oh, these are going to cost us $45 million more to pay out than we thought. And that $45 million, it gets ripped straight out of this quarter's profits. So what on earth is social inflation, anyway? It sounds kind of vague, right? But it's a very real thing. It's basically the idea that insurance claims are getting way more expensive, not because of the economy, but because of, well, society. You're seeing more lawsuits, lawyers are getting more aggressive, and juries are handing out these absolutely massive awards. They call them nuclear verdicts. All of this makes trying to predict how much a claim will cost in the future incredibly tricky. And if we look at where that $45 million hole came from, it's really specific. It's all concentrated in two areas, general liability and commercial auto. But you know what's really worrying investors? Look at the timing. These aren't some ancient claims from a decade ago. We're talking about accident years from just the last couple of years. That tells the market this isn't an old problem they've fixed. This is a right now problem. All right, so that's the mess. It's a tough spot to be in. The natural next question is, what's the plan? What is management actually doing about it? Well, they've laid out a pretty clear three-part game plan to tackle this head-on. First up, pricing. They're getting aggressive, jacking up renewal prices to try and stay ahead of these rising costs. Number two, they're getting way more disciplined with their underwriting. That means they're being a lot pickier about who they'll insure, even if it slows down their growth. And third, they're playing offense on the claim side. They're beefing up their legal teams, bringing in specialists, even jury consultants, to fight these big lawsuits in court. Now, it's easy to look at that big earnings miss and think the whole quarter was a disaster. But it wasn't, not entirely. If you look past the ugly headlines and commercial lines, there are actually some real bright spots, some parts of the business that were performing really, really well. And this right here tells the story perfectly. It's like a tale of three different companies under one roof. So the combined ratio, that's the key number for profitability in insurance. Anything under 100%, you're making money. Anything over, you're losing money. Look at commercial lines, 102.8%. Ouch, that's unprofitable. But then look at personal lines and their excess and surplus business. Both are well under 100, solidly profitable. So this tells us the problem is bad for sure, but it's also pretty contained to one part of the business. So why was personal lines doing so well? Well, this chart gives you a pretty big clue. A 19% price increase on renewals. Wow, management basically put the pedal to the metal on rate hikes. This is their strategy in action, right? They're willing to lose a few customers to get the profitability they need. And you can see they're not shy about raising rates in those problem areas either. Both are seeing double-digit increases. And there's another really important bright spot. It's on the other side of the business, their investments. Think about it. While the insurance folks were fighting fires with all these claims, the investment team was just cranking out returns. Their investment income was up a whopping 18% from last year. That provides a really powerful cushion when the core business hits a rough patch. So all of this gets rolled into their new outlook for the rest of the year. Let's break it down. The bad news first. They had to raise their guidance for the combined ratio, which is basically them saying, yeah, our core insurance business is going to be less profitable than we thought. But then there's the good news. They also bumped up their forecast for that investment income. So the signal they're sending is, hey, we think this investment engine can help make up for some of the pain on the underwriting side. Okay, so that's the quarter in a nutshell. A lot to unpack, but now for the big question, where does the stock go from here? This is the next call, our take on what to watch for and what might happen next. So here's what you need to keep your eyes on. First, we're heading into Q3, and that means peak hurricane season. That's always a huge wild card for insurers. We also have to watch those casualty trends like a hawk. Is this social inflation thing getting even worse? And we'll be looking at the data. Are there big rate hikes driving away too many customers? But maybe the biggest thing of all is credibility. Management has a bit of a credibility gap with Wall Street right now. They need to prove they have a handle on this before that next earnings call in late October. Now, if you're an optimist, if you're a bull on this stock, the argument goes something like this, and it comes straight from the CEO. They're saying, look, that huge $45 million charge was painful, we get it, but it's actually a good thing. It shows we're disciplined, we're facing the music now, and recognizing these losses early, while some of our competitors might just be kicking the can down the road. But of course, there's the other side of the coin, the bear case. And it really all comes down to one critical question. That investment income is fantastic, no doubt about it. It's a solid foundation. But is it enough? Can it really offset the wild swings and the deep uncertainty in their main job, which is underwriting insurance? Right now, with the stock down 17%, the market is shouting a resounding no. Confidence has been seriously shaken. So here's our prediction. For the next quarter, we expect more of the same, really. Those problems in commercial lines aren't just going to vanish overnight. The investment income will definitely help soften the blow, but it's not a magic fix. Because of that, we think the stock is probably going to be stuck in a range, just treading water until they can finally deliver a clean quarter. A report with a solid beat on the underwriting side that proves to everyone they've really got their arms around this problem. And all of that brings us to our final reading. We're calling this a market perform, which is basically a neutral stance. The thinking is pretty straightforward. That super strong and growing investment income puts a floor under the stock's valuation. It's hard to see it falling a lot further. But at the same time, there's just no obvious catalyst to push it higher in the short term. Until that core underwriting business stabilizes, it's really tough to imagine this stock outperforming the market. And of course, we have to end with the standard disclaimer. Please remember, this is just for informational purposes. It is not financial advice.